In this video, we're going to solve the exercise Minimoi. It says it's a small company is dedicated to personalizing dolls, so they look like the people they represent. During 2021, these have been the main operations that are related to results. We're going to start as usual by materials, and it says they use two different kinds of materials. On the one side, they have generic dolls. They're made of vinyl, and the invoice is related to this, some 300,000. They pay 80% each year and 20% remaining the following year. And then we have the amount of the invoices from the last year. This amount, 285,000, we will use it only in the payments. So during this year, we're going to have cost and expenses by 300,000. And when we arrive to payments, we will need to combine 80% of the amount of this year plus the 20% of the amount of the previous year. So there we go. So as I was saying, this is necessary for production, which means it's a cost. We relate it to the productive department, which means it's an expense. And finally, we arrive at the payment. And since they pay in two parts, we have to add the part they pay this year, 80% of the 300,000, plus what they have to pay, what is remaining from the previous year, and it's a 20% of the 285,000. So you can see here on top. Okay, so this is on the one side. On the other side, they have the elements to personalize. So to do so, they use a flexible paste that dries with the air, and they paint it with acrylic paintings. The paste is white, so they can get a special discount, a 3% discount. Okay, so total value of these materials is 12,000 euros. When we have this kind of discount, we first apply the discount, and then the amount after the discount is what we place in the chart. So the first thing is calculating the discount. So to do so, we multiply by 97%, or we do 12,000 minus 3% of 12,000. It's the same operation. There are two ways to do it. This is the amount we're going to place in the chart. This is a cost because we need it for production. This is an expense because it's related to the production department, and it's a payment. Okay? Now we move on to the salaries. How many people is working here? It says there are 5 workers. They get 1,200 per month with the payments prorated. And then there's one manager, which earns 1,800 with non-prorated payments. We have some information regarding the hours and holidays and so on. This is in order to calculate the productivity, which is going to be the next week. But for the moment, you just don't need this information, okay? So we're going to do nothing with this. What is important for us is this. The manager got 1,000 in advance from the next year. This 1,000 belongs to another year. When you have something that belongs to another year, it means that it's only a payment or a collection. In this case, a payment. Okay, so let's go for the workers' salaries. So we have 5 people. They earn 1,200 per month, and they have 14 payments prorated. Payments prorated means 12 payments. So this is a cost. It's an expense because it's related to the production and to the human resources department, and it's a payment. And regarding the managers, we have 1 person, 1,800, and 14 payments non-prorated. So non-prorated means 14 payments. This is also an expense. And regarding the payment, here is where we're going to add the 1,000 euros that the manager gets in advance. Okay? So now we're moving to the depreciation. And here we have a little unusual thing, something we have not seen before. Okay? It says that the company owns the machines that they use to melt the vinyl and shape into the generic dolls. Okay? They bought them by 100,000 and they have a residual value of 10,000. The company is going to depreciate it at 10%, but legally they have to do it in 15 years. Apart from that, they have small tools. These small tools are the ones they use to personalize the items, okay? So they are the ones to operate with the paste and to use the acrylic paintings and so on. So this is a small value, and they have decided to buy them new every year. This means the depreciation is 100% per year, so they change it every year. it says the cost is 1,000. There were several solutions. There were various ways in which you could interpret these. We're going to use the right one regarding this video, but I'm going to explain another one. So the right solution is these tools, they only last 1 year. So if they last 1 year, this is not a fixed asset of the company. And the things that are not fixed assets, they do not depreciate. They are considered a regular expense. So even though the information is given here with the depreciation, it does not mean you have to depreciate them. You have to think. They last 1 year. 1 year is not a fixed asset. Things that are not fixed asset, they do not depreciate. Another interpretation, which is not completely right, but let's say it's kind of the reasoning you could do, and it would not be completely wrong neither, is that you think, oh, yeah, so it's written here under depreciation, so I have to depreciate them. How much are they going to depreciate? Well, if they buy them new every year, it means they depreciate 100% every year. So you cannot include them here with this 100,000 to do a common depreciation base. You should do two different depreciation bases. One for the machines and another one for these little tools, okay? Because you cannot apply the 10% and the 15 years to these tools because they only last 1 year. So you need two different depreciation bases in case you go on that side, okay? But we're going to solve it as it is, as you should have solved it. So our depreciation base will only consider the machines. So we have the 100,000 minus the residual value. There are no lamps, okay? So nothing to do with the lamps. Now we're going to calculate the depreciation, the total depreciation, which is the 10%. So 10% of the depreciation base. Then we have the legal depreciation, which is 15 years. So we need to divide this 90,000 by 15 years. And the difference between total and legal depreciation, it's over the law depreciation. Once we have this, we can translate it into the table. So legal depreciation, it's going to be a cost and it's going to be an expense. While over the law depreciation, it's an opportunity cost, which means it's just a cost. And this is the moment for the tools. And as you can see, there is a special line for them because they are considered an expense. They are not considered part of the fixed assets of the company. So the tools, they're going to be a cost because they use them for production. They're going to be an expense because they're related to the productive department and they have to be paid, okay? Then we have other expenses. There's marketing and there are productive expenses. Let's go with marketing. Marketing, it's going to be a cost, it's going to be an expense, and it's going to be a payment, as usual. And then it says productive expenses. If this is related to production, it's going to be a cost. They say they're expenses, so it's going to be an expense. And it does not say anything about payment, but as usual, we consider it payment. That's it. Let's go to the financial situation. It says they got a loan at a 6% interest rate. They are going to reimburse it in 4 years, 50% first year, and the rest same amount each year. They got a capital grant and they have the corporate capital. As you can see in the screen, we have the loan chart down here, but I'm not going to solve it right now. I'm going to do just a couple of operations here on the left of the screen, so you can see what is the financial interest, loan for the year, and so on. And after I have finished with all the chart and after I have finished calculating the results, then I will deal with the chart, okay? So let's go on, let's move on. We have a loan that it's 90,000 and it says the interest rate is 6%. So our interest for the first year, the one we're going to place in the collection income product chart, it's going to be 6% of the loan, okay? And then we have a reimbursement. It says 50% first year. So we do 50% for this year, okay? Then we have a grant of 10,000 and then we have a corporate capital 30,000 with a cost of a 2%. So let's place the financial interest in the chart and we're going to consider it a cost because all loans the company gets are used for production. So this is a production cost. It's an expense because it's related to the production and to the financial department, and it's a payment because you have to pay the bank. Then we get the loan, we get a collection of 90,000, but by the end of the year, we have to reimburse half of it. So we have a payment of 45,000. Then we have a capital grant, which is only a collection. And then we have the corporate capital cost, which is 2% of the 30,000. And with this, we have finished with the regular operations. Right now, we have the information regarding sales and production. So you know that the first thing we have to do is calculating the cost price. So that's what we're going to do right now. First thing, we're going to add all the cost column. And then we're going to find out about the production. It says they produce 17,910 toys, all of them under demand. This means that the number of dolls, the number of toys they sell is the same as the number of toys they produce. So there's no warehouse, there's no stock in this exercise, okay? They produce under demand, so there's no warehouse, there's no stock in the company. To calculate the price, they include a 20% margin of a cost, and they collected 80% of sales. So let's move on. Here we have the cost price, which we calculated dividing the total cost by the number of units produced. Now we're going to calculate selling price, which means we need to add a 20% to this amount. So it's going to be 24.17 plus the 20% of 24.17. That gives us a total of 29 euros. So total sales, it's going to be, or income sales, is going to be 17,910 multiplied by 29. Okay, so the number of units sold, which is the same as the number of units produced in this case, multiplied by the selling price. And collections are going to be 85% of this amount. Now we're going to move these amounts into the chart. So we have, oh, sorry, I forgot the production. Yeah, we have the production, which is sales income plus the stock, the warehouse. And we said there was nothing in the warehouse. So production is going to have just the part of the sales income. And now, yeah, we're moving to the chart. So we have the collections, which we are going to write them under collections in the line of the sales incomes, which go in the column income in the line of the sales, row sales, and then we have the production, which goes in the column product in the row production. Once we have this, we can add all the totals of all the columns. And now we're ready to calculate all the results. The exercise only asks you to calculate the economic result, but I'm going to do all three, okay? So we have a monetary result, which is collections minus payments. And the company is doing great because this is a positive result. So the policy regarding collections and payments is good. Now we're going to calculate the economic result because we want to know if the company is getting profit or not, or losing money. So yeah, it's positive, which means the company is getting profits. Good for them. And then we have the internal result, which means how is the productive department working? And we also have a positive result, which means the company is working good. Now we're going to move on to the other part that you were asked to do, which was the loan, the chart related to the loan. So we're moving back here and we're going to check again the information related to the loan. It says it's a 90,000 euros loan at a 6% interest rate. They're going to reimburse it in 4 years. So we have a chart for 4 years. 50% first year, the rest same amount each year. So there we go. 1, 2, 3, and 4 years. And the company received 90,000 euros. So the first year, we're going to do an interest of a 6% of the 90,000. And then we're going to do the reimbursement, which is going to be 50%. So pending loan is 90,000 minus 45,000, 45,000. And this is the outstanding loan for the second year. So here is the thing. Now we need to deal with the reimbursement for the next 3 years. And there are 2 ways of doing this. Some people have opted for dividing the 50,000 by 3, which means you get a percentage, but it's not a percentage around 1. It's a 1 with decimals, okay? So you get 16.67%, which means at the end, the reimbursement is going to have decimals, and the pending loan at the very end is not going to be a real 0. It's going to be close to 0, but it's not going to be a real 0, okay? There's another way to do it, simpler way to do it. You have 45,000 euros to reimburse in 3 years. 45, you can divide it by 3, and you get a round number, 15,000. So that will be the easy way to do it. And it's right, okay? It's correct. It's also correct doing the 50% between 3 and getting the 16.67%. But it's a little bit more complicated because you need to operate with all the decimals, okay? So I'm going to opt by dividing 45,000 by 3 to calculate the reimbursement, okay? So let's go for the interest. So we're going to do the 6% of this 45,000, and now the reimbursement, 45,000 divided by 3, which is 15,000. So now we can calculate the pending loan, which will be 45,000 minus 15,000, 30,000. This is going to be the outstanding loan for the year 2. We're going to multiply this 30,000 by a 6% to get the interest. We already know what is going to be the reimbursement. 15,000 is going to be the same every year from now on. And the pending loan will be 30,000 minus 15,000. So this pending loan is the outstanding loan to start year number 4. The financial interest is going to be a 6% of the 15,000, and the reimbursement, it's going to be another 15,000. So pending loan, it's going to be 0. And this is it. This is the end of the exercise. This is everything you have to do. So I hope this video helps, and see you in the next one.